Well, good morning to all the Great Swan clients. It's the 6th of February already. Greg, we haven't done a fund performance and a market update for quite a while. We've never been good at these video recordings and webinars, but it's, I think, just something we got to focus on this year. We've got so much good news to tell our investors. We've had a phenomenal year, another phenomenal year, and we're not so good at getting the good news out there. So I thought, impromptu, Greg and I chatted last week and said, this year we're really going to make a concerted effort to update our investors about markets performance and also to give you a glimpse of just our day-to-day management of your investments. I mean, Greg and I speak probably 3 or 4 times a day, 7:30 in the mornings. We start chatting. The markets are open. We chat during the morning, and then we chat again about 11:30 after we've assessed all the analysis. There's a certain way we look at the market, certain performance and risk numbers. Our team also provides insights. And then just before 12 o'clock, it's all guns blazing. And then we have to put in the trades. And so I think this recording will just give you a good idea of what we do as the 2 portfolio managers to our Great Swan range of funds. So with me, I've got Greg. He is our Chief Investment Officer. Greg and I have been working together for, Greg, I think it's 22, 23 years. It's been a long time, but it's been an absolute pleasure. It's a dream come true. I think different to most fund managers, we actually think alike. Most fund managers always say that you've got to have different views in the boardroom. And I think for us, it's Greg and I think so alike that, when I call Greg, I say, Greg, we've got to think about this. He tells me the answers are already in your email box, and off we go. So yes, we sometimes do think differently, but it's an easy process. And I think because we think quite similarly, we can act quickly. And I think that is a critical recipe for success. If you just look at how the markets have changed since March 2020 and COVID, we have to move much faster. We can't be committee driven. We can't be sitting here having meetings once a week on a Friday, and we get the whole team together and we analyze and debate things, and then we only trade the next Monday or Tuesday. It's way too slow, and we've changed that process 3 or 4 years back. And I think today is a good reflection of some of those results. Now, Greg, this morning, as you know, I love just opening my Investingcom app. And I really put together these slides this morning. And for the viewers out there, Greg has not seen any of these slides. He doesn't know what's coming. And I just said, Greg, let's just do this. Let's spend 30, 40 minutes and give our clients a flavor of the performance, the year, our views going forward. So, I mean, Investing.com shows our 3 unit trusts that has been running for about 7 years now. Our latest unit trust only has about 15 months of track record, so it's not on the Investing.com app yet. But what you can just see is, importantly, if I move my cursor along these lines, all 3 of those funds are recognized by Morningstar's 5-star rated funds. So that's the top rating that you can get from Morningstar. They're probably the world's most renowned, most accredited rating agency of investment funds. So for us, just reflecting on the last year, we had a phenomenal year, and so the last 2-3 years, and since inception, the performance has been top quartile over whether it's the short, medium, or long term, and so a great result for our clients. I had to think about a name for what we're going to call these recordings, and I thought, if you look at our name, Great Swan, that Swan stands for sleep well at night. And Greg, until we can find a better name, if you can come up with something better, that's what we're going to call it. We're going to call it our Grey Swan or Swan recordings. And it's going to be at least monthly. Maybe we're going to just impromptu post a weekly update if there's anything interesting in the markets, or we see a great opportunity, or we've just done a good trade. I think we've got a lot of investors that follow us quite keenly. And so we'll give you those updates. So for now, it's going to be the sleep well at night.
Maybe not us sleeping so well. Our clients sleep well,
true.
But
that's true, Greg.
we await till what time of the evening, watching markets and looking in the morning, see what's happening, and every single economic event happening across the globe. So yes, hopefully our clients sleep well, but yeah, we are always monitoring the markets.
Yeah, Greg's just like that picture on the left. I mean, that swan. What our clients see is that steady and calm swan. But under the water, there's a lot of things going, and we look at so much data and information, and it is daily. My wife always says, whenever we're on holiday, we just always go. But we're passionate about what we do. We love what we do. So it's a daily inch by inch process, as you will see throughout the presentation. Greg, did you read any books in December? I know the previous December you read Matthew McConaughey's book.
Yeah, well, it was Matthew McConaughey, and then the lead singer of Foo Fighters, just something different. And then this year I decided to read Andre de Ruyter's ESCOM book, because of the political environment we're going into, and sort of just delving into risks for the South African economy looking ahead. If you think about it, where we're sitting today, we have the SONA coming up, we have the budget coming up, typically during periods of time when the South African budget are coming up. The rand does quite poorly relative to other currencies, also other emerging market currencies. So I think it's quite critical. It was a great book to read, and again, I think it just highlights the importance of how the election plays out this year, because given the corruption within government, or the corruption that's happened at various of the state-owned enterprises, it's going to be critical to be able to sort of manage portfolios through this period. It's going to be very volatile, and it's going to give us a lot of opportunities. So that's the book I read. It's quite sobering reading the book, but it also gives me, I think it's going to give us some opportunities to make some good money for our clients. So I think that's how we're looking at it.
Yeah, it's one of those books that you kind of think, should I read it, shouldn't I? I toiled with the idea for a couple of months. I read it about 6 months back, and for me it was a worthwhile read, because there's a lot of things we don't like seeing and reading, but there's always good people out there, people that's working hard, that wants to do the right thing for this country. And I think that was some of the golden nuggets I got out of that book. If you just saw some of the more recent articles and Biz News, there's there's different expectations of what's going to happen with load shedding this year. The one article I read is just it may just be worse than what we've experienced today, but we'll see. Greg, the 3 books I read Sia's book. I actually finished most of his book just before the World Cup, in the run-up. I didn't read the last chapter. What a book! What an ambassador for South African rugby. And I mean, that book for me was all about, the Boks don't come up with excuses, they come up with solutions. That was one of the most important things. And I read Rassie, just different thinking. And when he spoke about his team, like he loves getting like real true mongrels in his team that can just fight it out and inch by inch and win. And then I read James Kerr's legacy book. It's about the All Blacks. I don't think many South Africans will read that All Black book, but it's one of the best 3 books I've read in my life. It was actually the 4th time I've read that book, and one of the greatest stories in that book is just how Richie McCaw, I think he is one of the best rugby players of all time, just says that every single day he diarizes, and in the top of his diary, he just says, start again. As good as he was, every day was start again. And it resembled what we do at Grey Swan. It's like every single day we start again. Greg and I start that process again with all the analysis, all the research, and we make decisions every single day. Now, if I reflect on the past year, I think one of the sad moments was definitely the passing of Charlie Munger at the age of 99. I think we all hoped that he was going to get to the 100, like Gary Player's also trying to get to 100. So we wish him well. And Charlie Munger and Warren Buffett's been absolutely inspirational for most of us as investors. And there you can see on the right-hand side the picture. Charlie's on the right of the screen, and on the left, his dear friend and partner for decades, Warren Buffett. Collectively, probably the smartest investors of all time. Warren always drinking his Coca-Cola, whether he's at the AGM or, they were an investor in Coke. And these guys have been our inspiration. So it's sad to see Charlie passing. Maybe just a quote there. Remember rule number 1. The first rule is never interrupt your compounding. And compounding is the 8th wonder of the world. I see just this morning on LinkedIn, I saw a post that Berkshire Hathaway, which is the company that runs all the money, just had, I think it's 5th best relative month versus the S&P 500 in its history. They've outperformed the S&P 500 by about 6% in January. So that phenomenal performance that you see there on the left continues. Now, if you would reflect on the year, it wasn't an easy year. If you just look back at the beginning of last year and you polled all the major economists, and I just extracted that little snapshot there from the Financial Times, that's a survey of 47 economists and what their view was for the year ahead. Most projected a recession, and the recession never came. So most investors positioned their portfolios for a recession, which is a kind of a negative, cautious stance to markets. And if you look at just what the markets yielded, I mean, it was a phenomenal year for markets. You wanted to have been risk on. And on the right-hand side, similar, most projected a negative outcome for the S&P 500. And the S&P 500 was up 20% and stronger. A nice quote there. Warren Buffett just says, be fearful when others are greedy and greedy when others are fearful. So beginning of last year was actually a time when most people were fearful, and that was a time to invest.
I think, Duncan, that sounds quite linear, the statement. It running into the start of the year, if everyone can recall, we had a massive rally in equity markets in January, and then started selling off and then rally again. And then what started happening is you had this, as they would call, the biggest anticipation of a recession. And that sort of pushed markets down into that third quarter. And then sort of GDP growth started coming in quite strongly globally. And suddenly markets reacted as the Fed stated that, well, they're potentially going to start cutting interest rates. So it sounds quite linear on how this movement was, but it was very volatile how markets moved through that period, especially last year. And there was a lot of opportunities to actually increase and decrease risk and take profits. And I think that's quite critical, what we did last year.
That's a great point, Greg. I've actually forgotten what a strong month January was last year. And we took some profits right after that month. And then November was also absolutely shooting the lights out month.
Yeah, the early Christmas rally. We were sitting waiting for the Christmas rally. We were positioning portfolios for Christmas rally with some protection in the portfolios, and it came early in November, running into December not so strongly, but again January you see what markets are doing again this year. So and still ongoing.
Yeah, I remember Greg's mid last year, you were telling me, got to be right for this Christmas rally. It happens too often, and what we've seen over and over is that maybe the markets doesn't repeat itself exactly, but it kind of rhymes broadly. So you got to take history into account. And I think, Greg, because such a lot of trading these days are algorithmic, and you got AI and systems, they look at these numbers. And I think that's also one of the reasons why the pendulum swings so much, sometimes in one direction and then the other direction. And, there we had the big run in November. So fortunately, we did start to increase our equity allocations after being quite cautious for most of the year. Now, I can show you many market players' views of the market. On the left-hand side, I'm just showing you one of the biggest players in South Africa. If your forecast was a -15 for global equities, and finally the year was up 20, and the majority of your assets are on equities, then you missed out quite big. But it just shows you the risk of trying to make big predictions about markets. And most fund managers don't make big calls. They have views and they make incremental allocations, but it just shows you how difficult it is to asset allocate or to forecast, as I've also shown on the previous two graphs. And on the right-hand side, I just saw that on LinkedIn as well. I mean, the market's just talking about the soft landing. Everybody's expecting a soft landing. And if you go back to 2007, those were the headlines too. And we all know what happened in 2008. I think the market dropped 50%. And Greg and I was actually in New York at the time. We were managing an offshore asset management business, and we saw how people had to exit Lehman Brothers' building with their boxes and stationery, and it happened very, very quickly. And we got a similar type narrative again this year. You know, people are just thinking the Fed's going to cut rates, inflation's coming down, it's going to be a soft landing. Maybe it's going to be like that. We'd all be grateful. We'd be happy if that's the case. But I think, Greg, you know, we are very cautious about the current positioning.
I mean, you've already started seeing some pressure if you're looking at the US regional banks, how those stock prices are down due to sort of a lot of exposure to the REIT sector or to the property sector. And that's causing a bit of strain already in the market. So it's not rhyming to 2007, 2008, but I think it's just keep your eyes open, because you're in a different environment where, you know, liquidity is going to get less in an environment potentially. You know, just being past inflation at this point is not a given. Last Friday we saw massive jobs data coming in, so it's not so straight in terms of a recovery through year or further rally in markets rather. So I think just be careful on the narrative in this environment.
Yeah, Greg, if I reflect also about last year, I mean, we know the box won by 1 point and 1 point and 1 point, and then, you know, Drickus this year also by 1 point. And it's a reminder about just how, whether it's life, whether it's business, whether it's investing, it's about those inches. And if you recall, about a year back in our strat session, I used this Al Pacino speech on, you can find it on YouTube. I watch it often. I watch it at least once a month. It's just so inspiring. That extract from that movie, Any Given Sunday, where he talks to that American football team, and he just talks about it's about the inches, but it's about those marginal gains. And that's what last year was all about, Greg. You mentioned it, you know, it was a very up and down year. You had to be in the market, then you had to be out of the market. You had to claw for those little inches. And I think that's what we did well last year. And then we also spoke about that book at the strat session. One of our advisors, Martin de Jong, had read this book, and most of us have read this book now, Atomic Habits. And it's just about those small changes that you make. And I remember how she talked and spoke to us about that English cycling team, the Sky cycling team, how they made small changes to their process. They even went and painted their, you know, the storeroom in which the bicycles traveled white, so that they can see if there were any dust, because if there were dust, it would go and settle on the bikes, and that will make them 0.001 slower. So it's all those small things, and that's what we kind of did this year, Greg. And you know, we're not here to win awards, and you know, it's nice to pick up trophies like the box and Drickus. We're more about just consistency. But Greg, I think it is nice that suddenly we are being recognized. We saw on CityWire a couple of months back that we were recognized as on the short list of 5 for our moderate fund. And we are now, Greg, both you and I have portfolio rankings. Maybe you just want to tell our clients just about what those ratings are all about.
Yeah, I mean, you can read it on the right-hand side and go into CityWire's methodology in terms of the rating. But basically, they screen the whole universe. It's not just a South African business, it's globally. My understanding is that they screen over 6,000 funds. And then what they do is they look at the portfolio managers running these funds. So if you're running 2 funds or 3 funds, they look at the alpha you're generating and your performance and risk relative to that peer group. And then they aggregate all these numbers together and then rate you as a portfolio manager. So less than 25% of managers across the globe are actually even rated. And then you can sort of see the screens at the bottom there. And yeah, we're proud to say that we are now rated portfolio managers, which again just shows it's not just from a South African market. It's about the, you know, consistency of alpha we've been able to produce within all of our funds, not just one. I think that's quite critical.
Thanks, Greg. And yeah, if you look at the results, that was the fund that we got that recognition for. It's the moderate fund. So it's our unit trust fund that targets inflation plus 4. Typically, the risk profile is for, you know, a client that can tolerate, you know, 10% downside in any 12-month rolling period. It has 40 to 60% in growth assets. It is regulation 28 compliant. And there you can just see whether you look at the 1 year, 3 year, 5 years, even the inception numbers right there, last line, you see a number 1, and that means top quartile. So it just means that you're in the top 25% of your class. And you can see there for the last year, I think it was a phenomenal year. 3rd out of 98, the last 3 years, 2nd out of 94. And those are all our peers that are running FSCA regulated unit trust in that moderate category. Also, what we saw, the Korean report is a very nice report to read. I've started reading it every month when it comes out. I haven't seen the latest one yet. This was up to end of November. And it was nice to see that on the right-hand side there, you can see our cautious fund was rated 2nd out of the universe of conservative funds. So those conservative funds target inflation plus 2 to 3% with a maximum of 40% to growth assets like equities and property. And for an investor that invests in those type of funds, you should be able to tolerate a loss of 5 to 10% over 12 months rolling. So we had a really good year in our cautious fund. And there you can just see over time, the last year, 3, 5 years, consistent top quartile performance numbers. And then the aggressive fund, similar results, maybe not recognized by the industry yet, but phenomenal results. Again, it's the same story, top quartile performance numbers. Now, I want to show this slide because I think it's quite important in the sense of just showing you how we manage assets. I mean, this was our most aggressive fund until we launched our flexible fund about 15 months back. And what you can see is the aggressive fund, that blob C, the pink blob, and you can just see that it's been one of the best performers versus any asset class that you could have been invested in. So what we don't do is we put all your assets in offshore equities or all your assets in local cash or all your assets in one asset class. We diversify it across many asset classes, and then we tactically allocate, and we also hedge certain asset classes. So what you can see there is the performance is of the best performing versus any of those asset classes. But most importantly, as you can see that block C is far to the left-hand side of the screen, meaning that it's of the lowest risk. So we've been running that aggressive fund at like bond type volatility or risk, which is low risk, but we've yielded high returns in line with other aggressive funds. And it's just the manner in which we have managed the assets. We have been very cautious at times, then we've moved up the risk profile, but we've hedged the assets if we've moved up the risk profile, and those are the results. And if you want to summarize the Swan way of managing money, it's about the inches, it's about the small changes that we make. Yes, we are active, but it's about the risk management, how we hedge and how we protect on the downside, and how we take profits when things have performed well. And that's something that we've learned. Both Greg and I managed offshore hedge fund assets. I mean, that's critical about that process. And we've just adopted that process across our unit trust. So, we launched the flexible fund 15 months back. And the flexible fund is similar to the aggressive fund. It also targets inflation plus 6, but without any constraints. The aggressive fund is a regulation 28 fund, so it's there for annuity money, for retirement money. But we realize there's a lot of our clients that has discretionary money that don't have to be constrained by regulation 28. And we can actually, within this new fund, apply our best views. We can hedge currency, we can hedge local equities, offshore equities, we can invest in exchange traded funds. It's literally our best unconstrained views. And I think this has been the highlight for me, Greg, over the last 12, 15 months. It's a difficult fund to manage because we're competing against our peers that also has an unconstrained toolbox. And what you can see there's that line A, we yielded 30% over the last 15 months. I mean, that's a handsome return. And we beat the peer group in that category, the flexible category, that's line C, by about 5% just over the short-term period. And, similar to our aggressive fund, line B, which yielded 25%, also a handsome return, and beating their respective peer group, the multi-asset high equity, line D, by about 7 or 8%. So we've adopted the same process which we run the aggressive fund in, The only difference is that the flexible fund, we are unconstrained, and it's really our best views. And I think this has been most pleasing. And if you just look,
you spoke about inches. Yeah, it's interesting trying to find the inches, because you got to look for the inches. I think that's quite critical. So you need to understand what you're looking for. And to give an example, last year, November, we were looking to increase global equity exposures, trying to get into that Christmas rally, but we were still worried about sort of inflation prints coming out in December and what the Fed's going to do, because that could just tilt it out. So what we did is we looked in the derivative markets, looked for sort of pricing. How do we get long exposures on the S&P, but without the downside risk? And effectively, what we could do is we could buy equity exposure, paying away a 1% premium, meaning getting the income for the month, holding the assets in cash basically, but buying long equity exposure in that worldwide flexible fund. So effectively what happened is the markets rallied and we got the full upside. We only paid away the 1% premium, a way to get that full upside exposure, but we had no downside risk.
Yeah.
And that's marginal moves you're putting into these portfolios, trying to manage risk, number one, but looking for opportunities, when they arise. But you need to look for it. I think that's the key.
Thanks, Greg. I mean, we've got a section on hedging, so we're going to delve into that a little bit more deeper. But again, here it just talks about, had you invested all your money in one asset class, and let's say it was you with perfect hindsight knew that world equities are going to produce this phenomenal result, whereas most economists predicted a recession. Most market observers thought that the offshore markets would produce a negative return for 2023, and the world index in rand terms produced 37.21%, and there you can see all the other asset classes, but the flexible fund was the second best performing, let's say, if you can call it an asset class. But we were so diversified across all those asset classes, but we came on second, and it's about that diversification and just managing it very tactically. And this is to the point. Look at block C, which is the flexible fund. And then I've also depicted all those asset classes on a risk-adjusted basis. And you can see C is of the highest returns. Yes, A has outperformed us, global equity, but we've outperformed those other asset classes, but at like twice or 2.5 times less risk. So you can see we've been running it like a bond volatility, which is a cautious profile, but we've been getting growth asset type of returns. And it just gives our clients that sleep well at night factor. We're trying to manage the surprise on the downside. We're trying to manage for black swans and gray swans and portfolios, things that you can't see or very difficult to see and difficult to manage. But we've also always got that protection in the portfolio that Greg speaks about. And so we've got the protection, but we don't miss out on the upside. And that's what the results are. And
sorry, Duncan, on that point, I mean, it's quite critical because you've had this massive tech rally, the Magnificent Seven, which is, well, except for Tesla now, 6 really, which has pushed up markets. And we've sort of held up well relative to global equity markets in an environment where we've hedged 20% of offshore equity exposure. So if markets falls, we have protection in place. We only have about 60% growth assets or equity exposure in the fund currently. So it's held up very nicely. But it provides very good protection for in case there's sort of some reversion in specifically these US tech stocks.
Yeah, it's a good point, Greg. I mean, I think maybe we had 40% in global equities, and we just underperformed global equities if you had put 100% of your assets in global equities. But we did it at, let's say, 2 to 3 times less risk. And that's your point. I mean, we've had a good year. Our unit trusts are growing very nicely, and we're proud to say that we're closing on that 1 billion mark, which gives us clout. It gives us adequate assets to do what we want to do. If we want to hedge, some of these hedges, you need to put 50 to 100 million rand to work to hedge the S&P 500. So we are sizable enough, but we are nimble enough. And I think that is a major edge for us is, we're not managing hundreds of billions of rands. We're not an oil tanker. We're not committee driven. We don't meet once a week and then implement the week thereafter. We're a nimble team, highly experienced and very stable. And then Greg and I look at the numbers every single day, and we trade, and we make those calls. And so at that size of close on $1 billion, it gives us enough clout, but we remain nimble. And just a big shout out and a thanks to all our clients and investors that's backed us, from the start. I trust that the numbers are very pleasing to you. So those are just some of the results and the funds, and we'll continue to give you the updates. The fact sheets for end of January, they're nearly done, so they'll probably be produced in snippet form in the next couple of days, so look out. And Greg, we've had a good January again.
Strong January again.
Yeah.
It's just January's been a quite volatile month, just looking at the currencies. And we've had some nice currency hedges overlays within that. When the rand strengthened a lot, we increased offshore exposures again. Rand blew out with the latest US jobs data. The Fed coming out potentially not cutting in March, only later in the year. And again, that positioning has worked very well for us.
Yeah.
So it's going to be a strong January again for us.
Yeah. So there's good news coming. Now, if you just reflect a bit about the markets, and this is up to end of January. I think if you look at the 1 year numbers there, this is from the Korean report, disappointing. SA equities minus 2.6%. I mean, look at the difference between the South African stock market versus global equities, in rand terms. I mean, that's a 27-28% spread. And our market was cheap last year. It's now much cheaper. And so, we are looking to increase as we have been over the last couple of months, but it's just disappointing, Greg.
Yeah. Well, you can moan about the South African market. You should rather go look at the Chinese market.
Yeah.
Go look at the Hang Seng. You're down to levels we've last seen in 17 years. So in 17 years, you haven't made money. Those valuations are trading at some of the cheapest multiples relative to specifically developed markets. So it's not only the JSE that struggled. It's various other markets across the globe as well.
Yeah.
But as you know, structurally, the JSE has changed a lot. And what we've done is actually sold out of a lot of JSE exposures just because of your exposures to China, and rather bought some of the China's exposures across the globe, globally, in hard dollar terms, to make sure we get some diversification from a currency perspective. So it's been all about you need to look at markets in the currencies as well. But yes, the JSE has been disappointing.
Yeah, unfortunately, Greg, when Regulation 28 was relaxed, and that maximum was moved up to 45% offshore assets, we moved quickly, which in hindsight was a great decision. And obviously, like you said, we've hedged the currency as well after we had moved aggressively. But most of our funds are more overweight offshore than local equities, and that's been a big benefactor for us.
Yeah.
Now, if you look at the local market, I mean, Greg, you know this well, but we've just been under a lot of pressure. Foreigners are just selling our stocks. But of late, if you look at the multi-choice, the bid that came in, I think there's a lot of interest in our mid caps because they are just so cheap. I think the multi-choice offer has been rejected. And that was at a 40% premium. So I thought the board would have an interesting decision to make, but they've rejected it. But it just shows you how cheap our stocks is. But there's pressure on our market. And, a stock like Naspers, one of the biggest stocks in the market, it's a very volatile stock. And we saw this year just, if there's news from China, that stock has taken an absolute pounding. And if you are a big investor in Naspers, Tencent, then you're going to lose and win with it. And, that's something that we manage over time. Also, just a reflection about the last year. Interesting, if you look at all assets globally, it looks like the allocation to passives or tracker mandates are now exceeding active managers. So I think more and more investors are becoming aware of the fact that it's very difficult for active managers to outperform the market. And the right-hand side, they talk about a needle in the haystack. Now, I mean, our clients know that we've had a very strong bias to passive investors since we started the business 13 years ago. In fact, our offshore asset portfolios are typically 80 to 90% in passive and tracker funds, because it's so hard to beat that market. And this last year was no different. If you just look at the asset flows, and a lot of the funds are struggling. I mean, there's some, I'm not going to name names, but this was an article that came out on MoneyWeb, and these two funds have got long track records, and they haven't even been able to give you inflation over the last decade. So it's not just about going and picking a few active general equity unit trusts and think you're going to do well. It's a very difficult game to pick active fund managers. We have allocations to active fund managers, but we tilt those quite actively. When those managers have done well, we take profits. A good manager that's just underperformed, we increase the allocations. But Greg, we like passive mandates, and our aim is just to increase those allocations over time and to just further reduce the total expense ratios of our funds. I mean, it's already close to bottom quartile if you look at total fees. So we're of the cheapest in the industry, but we're going to keep focusing on bringing those costs down. Now, this was an interesting slide that I saw. I attended a coronation conference just about 2 weeks back, and they just showed what the average allocation of investment advisors are to passive funds. And you can see on the right-hand side, most advisors are buying into the concept of having an allocation to passive funds, but it's low. You can see there 13.8%. Our allocations have at least been a third to even the majority in our funds, and we'll keep on increasing that, dependent on the style and the valuations of the market. So we've been a strong proponent of passive, and for us it's active and passive. But I think you can clearly see our allocations are much higher than the average advisor. And then on the hedge side, most managers don't hedge. They don't buy derivatives to protect on the downside, whereas we do. And you can see there's some advisors do allocate to hedge funds that do that on behalf of, let's say, the advisor or in the portfolio. But those hedge funds are very expensive. Those hedge funds, the total expense ratios are running at 4.5% to 6% in costs. And yes, there's a place for hedge funds in portfolios, but with our background, we've run hedge fund money. We actively run those hedge strategies ourselves across the portfolios and at institutional fees. I mean, those costs are less than 10 basis points to trade. Now, I do want to go into hedging a bit, Greg, because I think this is our edge, and it's been one of the reasons for our good performance. Now, if you look at the market, I think everybody's just, from being so pessimistic a year back and talking about recession and the market's going to produce a negative return, suddenly the market's kind of on, they're all putting their money on red or black and saying, well, it's going to be on red because the Fed's going to cut rates. And the market's in this kind of this greed phase. And we've seen when the market's in that greed phase, you've got to be very cautious. And back to this slide that I showed, we like to hedge. So allocation across our funds, I mean, if you look at flexible, we hedge currency, we hedge the S&P 500, we hedge SA equities. I mean, Greg, our total hedge allocations at flexible is typically 20% and higher, not like 3.9% of what
No,
was in the
it's
industry.
high. And
Yeah.
I mean, just to clarify, what do we mean with hedging? It's quite important. It's the same concept as insuring your car or insuring your house. It's all that we're doing. We're going to the markets, and simplistically, if you haven't had an accident in 5 or 6 years and you insure your car, it's going to be cheaper. So there's periods in time where it's cheap to buy insurance on the market. If you've just written off your car, you get a new car, you write it off again, your insurance premium is going to be a lot. And it's the same concept. If you've just gone through a market crash and you're trying to hedge or buy insurance on the equity markets, on the markets, it's going to cost you a lot of money. It's not when you want to hedge. It's about trying to buy insurance cheaply and trying to protect your assets after you've had a big rally. So that's all we'll be doing, is looking to put some protection in place in portfolios.
Yeah. Greg, you can see here, I mean, everybody knows the US market is expensive. There's pockets in the US market that's expensive. But to your point, I mean, you got to hedge, or you got to insure your house, you got to insure your car, you got to insure your fancy mountain bike or your jewelry. Yeah. And that's what we do in investments. And you can just see here, I mean, the S&P 500 is an expensive market. It's done exceptionally well yet again. And, but, most people just think it's going to continue to go up. But for us, we get excited because we see that the cost of insurance is at like lows if you go and look at the last decade or so. So then we go and insure our house or over-insure our car.
Yeah, and it's quite critical to be able to do this, because if we get to a point where the Fed does start cutting interest rates, I think there's a couple of dynamics that's going to happen in the market. You should see the dollar starting to weaken. You should see commodities starting to rally. You should see REITs, meaning local property, starting to rally. And you sort of need to be positioned for it. And you could see a sell-off in some of the long duration tech assets. It depends. But the hedging gives us, that positioning or protection in terms of positioning on having big offshore assets, protecting the currency. If the dollar weakens, at least we don't take the knock on the rand. And that's how we can sort of position our portfolios. So it's not so much of taking a view on what the Fed's going to do, and getting that call right. It's rather sitting in front of where the Fed's going to potentially pivot or not pivot, looking at where the markets are positioned at that point in time, thinking, what are the markets for positioned? If the markets are wrong, where do we think the risks are, and how do we position portfolios by implementing some hedges across portfolios to give us some protection? That's sort of how we're running these overlays.
Thanks, Greg. I mean, we're talking about hedging, but on the other side, there's opportunities. And this is a bit of a consensus trade. I mean, we know the numbers. Emerging markets are cheap. China's very cheap. And we've just seen some big flows into emerging markets. So it's something that, we're constantly watching. We have increased our allocations. So herein lies an opportunity, but again, lots of risk. So we're even looking at ways to further increase our exposure, but trying to protect on the downside. Not an easy feat, but we are looking at opportunities there. And you can just see.
Just today, Duncan, this morning, you would have seen that China came out. I think it was their pension fund, one of the biggest pension funds, saying that they would try and stimulate the stock market through adding into stock. So we've had a 4% rally in the Hang Seng this morning. Yeah. And you've had Chinese government speaking about stimulus, and that Chinese market's very volatile and rallies very quickly. So potentially because of the way the markets are positioned, everyone's so negative on China. Any good news could push this market up dramatically, and it is trading at 17-year lows. So in our view, you need to have a position in there. I think the risk is worth it, and if we could add some additional risk metrics on top of holding that position, I think it makes sense.
Greg, I'm going to fasten things up. We've got like 3 minutes. I do want to finish on the hour. Maybe just your thoughts on currency at the moment and our positioning, our hedges.
Yeah, so as I mentioned, what's going to happen with the currency. Firstly, you need to look at the currency, not from a rand perspective, but from a dollar perspective. I think that's the most critical point in most environments. This environment is probably going to be a bit different running into this year, but in most environments, look at the dollar. So in terms of the currency, we've had one of the strongest bull markets in the dollar we've seen over the last estimated 20 years. And that's because of interest rate differentials. So meaning you're getting a higher yield in the US than what you're getting in other developed markets. That pushes the dollar up. Now, when the Fed starts potentially cutting interest rates, you should see this interest rate differential between the US and Europe coming down, and you should see the dollar starting to weaken. So that's why the rand's so weak in our view. One of the reasons it's so weak in our view. So in the next cycle, you should see the rand a bit stronger. The problem is we are going into SONA, we are going into the medium term, or rather the full budget this month. And typically what happens in a month like that is the rand weakens relative to other emerging market currencies and developed market currencies. So we're probably going to see a bit of pressure on the rand throughout this month. Further on, and then we're going to go into elections. Now, I think that's going to be volatile. If we have a big surprise on elections, a negative surprise on elections, I think the rand's going to take a beating. So how are we positioning portfolios is rather, I want to have big offshore exposures because I don't want this very centric risk on the South African market where if something goes completely wrong, the rand could lose a lot of ground very quickly. But what we could do is we put some protection on the currency, saying that if there's a good election coming through, the currency should strengthen, and we'll have some protection in place to actually protect us in that environment. So that's sort of how we'll look at the currency throughout the cycle, depending on where it's trading, and look for opportunities to implement some hedges, or even increase offshore exposures where we can.
Yeah, thanks. I mean, we like hedging above that 19 Rand level. So if the Rand further weekends, we'll be hedging some more. Just on expected returns, there's a few slides from fund managers, Investec Coronation. I mean, everybody's expecting equities for the next 5 years to do well. So one doesn't want to miss out, but you want to be protected. And yeah, just looking ahead to summarize, Greg, you've been a good sport. You haven't seen any of the slides, and we've quickly looked at the fund performance and macro. Maybe at the next recording, we can delve into just maybe one of the asset classes and spend a bit more detailed time on it. But, going forward for us, it's about just sticking to our plan. They say, if you read Sia's book, when the Springboks plan A does not work, we switch to plan A. And so that's what we're going to do here at Grey Swan. We know what works. We've adopted a slightly different philosophy since COVID. We've been more active because the market changes very, very fast, and you can just see it in the last 3, 4, 5 years of results. But it's like the bomb squad. We know what works, and that's what we're going to do for the next years to come. We're going to keep scrumming, keep dominating, and just play our game. So, Greg, thanks for being a sport. Maybe next time I'll show you a few of the slides before we have our webinar, but maybe a last message from your side before we just ring off.
Yeah, thank you. I think critical just for our clients, it really is about inches. It's about where we're putting positions in place, specifically around, some of the most important macro drivers you've probably seen over the last 10 years is going to come in this year. And it's about cutting interest rates or not cutting interest rates. It's about what inflation's data is going to do. It's about geopolitical risks. And this is going to massively impact markets. So for us, is if we can make some money on positioning portfolios, making some shorter term allocations into asset classes, making 2 or 3 basis points in the portfolio through this while managing risk, I think it makes absolute sense. So that's what we're going to keep on doing. And it actually makes me excited this year. I think a lot of people get nervous about the environment we're going in. I'm not. I'm excited about this because I think it's going to give us a lot of volatility in the markets. Duncan and I had this discussion 4 years ago already, saying that if bond yields keeps going up, we're going to have more volatility. More volatility is going to give you more opportunities to make money, but you need to be more active. So I'm excited for this year. We're going to have our clients hopefully sleeps well at night, maybe us not so well, but looking forward to it.
Yeah, thanks, Greg, and thanks to all our clients, our listeners. Again, we're at that 1 billion mark, so that's something to celebrate, and we're grateful for that and your support. And we're just going to keep grinding all those inches, and we'll keep you posted. As I said, Greg and I decided just impromptu we're going to have these calls. This is the first. We're going to wing it, and we're going to do more of these. So look out for at least a monthly update, and have a good week.